Hello, everybody. All right, we are back live today. I know we had some problems yesterday, and I'd love to blame it on a technical hiccup. I'd love to blame it on someone else, but to be quite honest with you, I hit the wrong button, folks. And when I went to start this thing, it pretty much crashed everything I was working on. So apologize for yesterday, but here we are. I am live now on the S&P 500 options pit here at the SIBO. And I don't know about any of you, but I'm going to turn the camera here real quick up to the big board as I do. How many of you had S&Ps up over 100 points today on your bingo card? I know it certainly wasn't me, especially with what we have talked about um, with 25 versus 50, and I was in the camp, that 50 would not be a good thing for the markets because it would show a little, maybe a little panic on the Fed's part. But you know what? That's why the market does what the market does. And, going into that move yesterday, there was a polling of lead economists. 75% of these economists, who are very well revered, well respected, had predicted a 25 basis point cut, not 50. So, you know, who knows? But to get this kind of reaction in the marketplace is stunning. It is nothing short of stunning. And I think there were a lot of people out there, a lot of big retail trading firms that were caught short on this move, especially after the fade yesterday. We always talk about when we go through the actual Fed day, we always talk about Fed's going to make their announcement. We're going to get an initial move, and then it's going to calm down a little bit until Powell speaks. And then when Powell speaks, that's when the fireworks happen. Well, you know what? Kind of same story played out yesterday. And the way that the market ended the day yesterday on the low of the day, giving up all those gains, and it wasn't down much by the end of the day, right? S&Ps were down 10 points or something. But on the lows of the day, it really did not, set up to look like we were going to have any sort of a big rally today. And this is, you know what? I would actually describe this as epic. I really would. So you guys are living through some epic times here. Is everyone everything coming through clearly? Guys, I'm so nervous about what happened yesterday. I just want to make sure everybody can see, everybody can hear me okay, because I got a lot to cover, a lot of great stuff here. Kim, thank you. I know you're here, and I know you're just rocking and rolling in the room over there. I also want to tell everybody that one of the things I wanted to do yesterday was put out. Oh, great, Ryan, thank you. Was have a contest for some swag. If you want to be entered in a contest for some swag, just put your name in the chat right now and say me. That's all you have to do. And at the end of the live stream here, we'll run a little contest here and we'll get a couple winners today. Now, we said S&P's up 105 right now. Let's just take a look at what the heck is going on here. This is Intel. Let me get the SPX out here. We've obviously broken out to all brand new highs, which I can tell you was really not expected. And, we actually are seeing the VIX. I'm looking up here. When I look up here, guys, I'm just looking at the big board. The VIX trading just under 17 or so, which is down significantly from yesterday, but that's still pretty high. That is still pretty high. Here we go. Here's S&Ps here, guys. So you can see we are at all-time highs. Where do we go from here? I mean, there's no resistance above. Doesn't mean we're not going to have a sell-off, but there's no resistance above here. But I want everybody to remember what the VIX really means. Okay, the VIX is a measurement of S&P 500 at the money volatility looking 30 days forward. Now, there's a real easy cheat, a real easy math equation to kind of give us a reference to what the VIX means. A VIX of 16, okay, a VIX of 16 is pricing in a 1% daily move in the S&Ps. So if we're moving, 1.5% a day, which I'm not saying we are, but if we're moving 1.5% a day, we should theoretically see a VIX in the low 20s. If we're moving 0.5% a day or 0.75% a day, That's what we see when the VIX was in the lower teens earlier, this summer, earlier in the spring, 10, 11, 12 or so. So just keep that in mind. A VIX of 16 is representative of a 1% daily move in the S&Ps. All right, let's look at some other really, really big movers today. And for those of you who trade with me, okay, you'll notice that many of the positions we put on in the last few days, even last week, we're taking profits. We're almost wiped out, not wiped out in a bad way. I shouldn't have used that term. We're almost our open position list is almost, down to zero because we're taking profits off the table here. And not to say that, many of these positions couldn't make even more. You get a move like this, guys, okay? You have got to be so diligent about taking those profits. You always have to be diligent about your risk parameters, but a massive move like this can set up for a quick reversal. Okay? Again, I'm not saying that we might see the S&P sell off 100 points tomorrow or next week or whatever it might be. But, I certainly have a feeling some of the euphoria is going to wear off. Okay. It's pretty busy here. It was calm for a little bit. It was super busy on the opening, calm for a little bit, and it's picking up again right now. I can hear a lot of chatter, a lot of noise. When we get something going on here, I'll get the camera to everybody. Let's really, though, take a look here at what this 50 basis point move means. Okay. What does this 50 basis point move mean? And let me pull this in here. This is one of the things I wanted to talk about yesterday, but didn't get the opportunity. Hopefully you can see this graphic up here. And this graphic actually doesn't bode necessarily well for the marketplace. Okay. Not that it's a bad thing, but when we have gone into an easing cycle, when the Fed has started to cut rates, okay, when it has been a 25 basis point cut, we have seen on average a 24% increase in the S&P over the next year. When we have seen an outsized cut of 50 basis points, or I don't know if there's ever been a cut greater than 50, maybe in an emergency back in 08, 09, I'd have to look. But when there's been that first cut of 50 basis points or more, okay, it's still bullish, but not nearly as much as a 25. This was 5.2% gain in the S&Ps over the next year. So, is that going to play out this time? I got to tell you, folks, what we're going through right now in this cycle that we're going through right now, the data, looking back at historical data, boy, this is a different ball game right now. It really is a different ball game. Whether you believe what Powell and the Fed have to say, whether you believe the eco data that's out there or not, okay, this is a different ball game we're in right now. We're in a different ball game right now because inflation's coming down. The employment figures, the employment data is going up, meaning unemployment is actually going up. Francisco, I agree with you. I see that right now about what you said. It's good that we were wrong about the 50. I couldn't agree with you more. So, anybody that listened to Powell yesterday, okay, he used one word, I believe it was 10 times. The word transitory is what he has used for years. Inflation is transitory. Inflation is transitory. Blah, 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 blah. He used the word recalibration now, and that is going to be the buzzword moving forward. Now, what does that mean? What does his recalibration mean? Well, what it really means is we're recalibrating the bar of where the Fed believes inflation is headed and where unemployment is headed. And they're both, even though they're moving in opposite directions with inflation coming down and unemployment going up a little bit, Okay, and unemployment is still well under historical averages. Okay, that is their recalibration. Now, to go along with that recalibration, one of the other things, and I think I touched on this on um, on Tuesday, and then due to my mess up yesterday, I didn't get to it. I want to show everybody this thing right here, the Fed's dot plot. Can everybody see what's on the screen here? Okay, we started talking about this the other day. 4 times a year, at 4 Fed meetings a year, quarterly, every Fed member, there's 19 of them, every Fed member comes out with their projections of where rates are going to be. Rest of this year, out to 2025, 26, and now for the first time, we're actually getting projections out to 27. This is the first time we're getting that. This gets updated quarterly. So we have not seen this new revised outlook, if you will, for 3 months since June. And if you look here to see what the projections are, you can see some pretty hefty cuts that they are still looking at. This is really a lot different than what the dot plot was back in June. Why is it so different? Well, because the eco data that we all watch and that the Fed watches has significantly changed. Again, inflation and unemployment. So if you look here, okay, after yesterday's cut, okay, they're expecting, or the market is expecting, based on the Fed members, another 50 basis points of cuts this year. That would give us this total of 100. We already had 50 yesterday. So whether it comes in two small packages, the November meeting a quarter and the December meeting a quarter, or whether November is 50 and then they take a pause, okay, 50 basis points further is what is priced in according to the Fed members for the rest of this year. You can then see in 2025, again, however that may come about, whether it's 4 quarter point reductions, whatever it is, they are pricing in that by the end of 2025, another 100 basis points or 1 full percentage point of cuts, so on and so forth. I don't have to explain every number to you on this chart. Okay, I don't have to explain every dot. But what you will see, what is, what I think is fascinating, and I'm not an economist, but I love economics. Okay, I play a doctor on TV, that sort of thing. What is fascinating to me is where you see the majority of the Fed heads, 19 of them, coming in. And that's where, the majority of these dots are at. Okay, and you certainly see some outliers. In fact, yesterday's decision was almost unanimous. There was only one Fed head, um, Bowman, that voted for a 25 basis point cut. Everybody else voted for a 50 basis point cut. So this is something really, really important to watch. We won't get a new dot plot until the December meeting. And, we can compare at that point to see if there's anything different, if the landscape has changed. Has the economy gotten better? Has it worsened? Has inflation ticked up at all? Okay. And small biz productions, whoever that is, small biz productions. I got to give you a shout out here in the in the chat because you're right. They are more worried about unemployment and housing adjustments. There's no question about it. Nicely done. Robert, as always, Robert, I can count on you to give us a great addition to whether it's the trading room or whether it's the live stream here. Yeah, Robert called this the scatter brain plot. I think we could probably throw darts at the wall and be almost as close as the Fed heads are. All right. Keep these comments coming, guys. Keep these comments coming. It's great. Okay. Now, another thing. Another thing. What do cuts actually mean? And how will it affect us? Not how will it affect the market so much or how it will affect our positions, but how will it literally That's called a Rorschach, Robert. That's called a Rorschach test in those ink blots. But how will this actually affect borrowing costs? Okay, just because we cut right now doesn't mean overnight borrowing costs are going to come down. And one thing to keep in mind, we've seen rates coming down and coming down pretty significantly over the last 4 to 6 weeks in anticipation of this cut. Okay, so we're probably not going to see an immediate impact. Okay, and even though 50 basis points from an interest rate move, a Fed funds move, is a big deal, it's not that big of a deal when it actually filters in to credit card interest, to mortgage rates, to car payment interest. It does add up. There's no question. It does add up. Okay. But it doesn't happen so quickly. Now, one thing that is just mind-boggling and is brutal, and it's brutal on a lot of consumers. The average, anybody know? Let me ask here, actually. Anybody know, and yeah, you could Google it, I hope you don't, but what the average credit card interest rate is right now? Does anybody know what that is? First right answer, you'll win some swag also. Okay. And yes, I know you could Google it. If you do, you do. Okay, we got a 22, we got a 24, we got a 25, and I know you're just rounding off there, but Gene, I'm going to give it to you. It's 24.78%. 24.78% if you're carrying a credit card balance. That sucks. That's brutal. However, this 50 basis point cut, this 50 basis point cut, this will be significant. And again, it's not going to happen right now, but you should see it on your next billing cycle. That's about the lag that you see. You should see those rates cut down to about 20.5% or so. Okay. Again, I mean, if you're paying 20 or 25%, I mean, ouch, ouch. But if you are, that is a pretty significant difference. That is a pretty significant difference. Okay, so that will affect your credit card payments if you've got a HELOC, a home equity line of credit, auto loan, whatever it is, adjustable rate mortgages. Okay, adjustable rate mortgages for sure. You're going to start seeing come down. But just remember that there has been an anticipation ahead of this over the last 6 weeks or so, especially if you look at the 10-year yield. Okay, and I'm gonna pull that. I'm gonna pull up the 10-year yield here. If you pull that up, boy, this thing was trading 4.5% not too long ago, and it's now at about 370. Let me pull up 10-year here. It is now 3.744. That is the yield that is most closely tied to your mortgage, to your auto loans. So this is just over one day here, but look at over the last 3 months. Here's that 4.5% that I was talking about right up here. That is a significant move down. And again, that was all in a run up to what the Fed is starting to do right now. Okay. So again, the 10-year is really, really what people look at. Now, here we go back to our CME FedWatch tool that we watch all the time. This is now the projections for November. September is now off the board. Remember, when we were looking at this just as short time ago as we weren't together yesterday, unfortunately, but Tuesday, the current target rate, the Fed funds rate, was 5.25, 5.5. After that 50-point reduction, it is now 475 to 5. These are the probabilities for November cuts. Okay. You can see right now 58% probability of a 25 basis point cut, 42% of a 50 basis point cut. So the market still is pricing in a 100% probability of some kind of cut in November. Okay. Now, I started talking about this yesterday until I realized that I hit the wrong button and the stream was all whacked out. Okay. Does anybody know here how these rates are calculated? Okay. How do we get this current target rate of 475 to 500 or 475 to 5%? Okay. Does anybody know how we get that just from a mathematical perspective? Okay. 100 mid. Robert, man. Robert, you're all right in my book. You know that? You're all right in my book. That's right. We start with a bond at full value of 100. Okay. And then if we take right here, if you look at this price right here, look at that price right there. Okay. That is the price on a 30-year bond. Okay. So if we take 100 less that price right there, that is going to get us, and it's not an exact calculation, but that's going to get us to what the projected Fed funds rate is projected to be. So that's how bond pricing works. And also remember, guys, when you're looking at bond pricing and bond yields, if you don't remember, it can be a little difficult sometimes to understand because they work opposite to one another. So when rates go up, bond prices are coming down. When rates are going down, bond prices are going up. So if we continue to see rates come down, okay, what's going to happen to the price of what's actually trading in the marketplace? That price is going to go up, 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 up. Remember, it's 100 minus that price to come up with the target Fed funds rate. So if we are going to eventually, let's say, settle in 3.5%, that means the bond that we're looking at right here is going to be somewhere around 96.5. Okay. So not that this is so, we usually stick right to trading and what's going on here, but there's so much going on in the marketplace right now that I believe is so important if you really want to understand how everything is interconnected and the economics of everything. And again, I'm a geek. I get it. I love economics. I love statistics. Besides trading, of course. So I just wanted to point that out to everybody. Okay, let's take a look. Everybody was looking at Nvidia, 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 right? What a run this has made. Okay, hang on. I'm looking at. I guess President Biden is speaking right now, so don't know if anything is going to change in the market. I'm just looking up here. He's talking about the cut, the economy, okay, blah, blah, blah. Anyway, back to NVIDIA. We talked about this the other day. Huge, huge comeback, right? From where it was. This was literally September 6th. This was 2 Fridays ago. The stock is up 20%. The stock is up 20% since September 6th. Where does it go from here? You know what? It's going to be a matter of what is the market doing from here. If the market continues to rally, it's not going to rally without NVIDIA rallying as well. And, quite frankly, vice versa. Probably vice versa. The big tech play might be back in vogue again now. Google has had its troubles. And for those of you in our room, you'll know that we took a position yesterday in Google, right? That we completely exited today. We took a long position in Google, made, I got to look, I think 60% overnight. And we took it because it was right on the 200-day moving average. But here's another one. This stock, not quite as quickly as NVIDIA, but since July 9th. So now we're looking at just 2 months rather than 2 weeks in NVIDIA. In 2 months, this stock is down or was down from 190 down to, basically 150. It lost 20+% of its value made half of that back. It made half of that back at this point. Is it going to continue? I would say it all depends on the state of the market. The market grinds higher, Google's going to grind higher with it. Okay? The one that everybody wants to focus on, and we will talk about this more tomorrow and probably Monday, is the small cap space. Because small cap stocks, if you think about it, what does small cap mean? It means they don't have a market capitalization as big as a Nvidia, as big as a Google, as big as an Apple, a Texas Instruments, whatever it is. Okay? The next tier down. Well, those stocks that are not as well capitalized, they typically have to borrow more money, whether it's for R&D or technology, whatever it is, they typically have to borrow more money. Well, if they have to borrow more money, what sort of environment would be good for those smaller cap stocks? Obviously, an environment where rates are coming down and not going up. So that's why small cap stocks are getting a massive, massive bump. And they have actually leading up to the run here that we have seen. Let me pull up the Russell. And by the way, for those of you that don't know, yes, this is the S&P 500 index right behind me. The VIX is over there, but I never talk about it. The Russell index actually trades just over to my right at about, I'm pointing out to 2 o'clock right here. Okay, here's the Russell. This is small cap. What a rally, especially off of this August 5th debacle, a month, 6 weeks ago when the world was falling apart because of the yen and the carry trade. What an incredible rally. This thing traded sub 2000. 1958. We're now at 2254. Okay? That's huge. That's 300 points. That's, 16% or so in an index. We're coming up now on some pretty big resistance just up above here in the Russell, in the small caps. So this is going to be a really big test. This more so than watching what the S&Ps do, more so than watching what the Dow or the Nasdaq does. This is going to be the test to me to see if the entire market rally can continue. Because if the small caps are really doing well, that does mean that this lowered interest rate environment is very helpful for the economy, is very helpful for the markets. So that's something that I would really like to watch, everybody, and I think you should keep an eye on as well. All right. Now, again, I really apologize for yesterday. And because of that, we got to give out a couple of swags today. So first off, you've got Michael. Gene won the credit card percentage. Okay, I am gonna randomly choose here one of you that said me earlier. I've got a random generator off screen here. Okay, and those of you that come up, the first one came up. Small Biz Production. Who is Small Biz Production, by the way? Small Biz, we need a little info from you. Mike, if you can pop up here to email us at the Prosper Swag, that would be great. Eric, nice. We're going to put up an email address up here, guys. So Eric and Gene so far, if you can email us at the email address you're going to see on the screen here in a moment, email us with your name, mailing address, and what size you wear, like in a t-shirt or in a pullover. Let us know, and we'll get that right out to you. We got Eric, we got Gene, spinning the wheel one more time. And Ryan Pomper. Ryan Pomper, are you still out here? We're going to do this on a daily basis, guys. We got to get this live stream flying around. We want you guys to tell all your friends and anybody to watch us, not just for the swag, but hopefully you're getting a lot of good information out of this as well. Ryan Pomper, you are here. Awesome. Again, if you can email to us also with all that information, fantastic. Before I leave you guys, okay, and we're running live webinars almost daily here at Prosper, and we know we get some great response. We have another one tonight. Okay, I think Mike just put it up in the chat here. Where'd that go, Mike? I lost it. I know we have another one tonight. I believe Mike Shore is running the Webby tonight. Oh, I'm sorry. Not Mike Shore. This is our futures trades. Okay? We do have a futures program, guys. Many of you don't know that because we kind of just launched it very quietly recently. We do have a futures program. Okay? If you are interested in trading futures, bingo, live webinar tonight. Okay? With our futures trader, Dan O'Brien, DOB. So sign up there. Again, everybody, thank you so much for being here today. I apologize for yesterday. Love to say it won't happen again, but I am so not technologically inclined that there are no guarantees for that. So have a great rest of the trading day. S&Ps are currently on their high of the day, up 108 points. Ciao, everybody. Take care.